Thanks for tuning in to this episode of The Resilient Advisor. My name is Jay Coulter, and joining me today is Barrett Ayers, the CEO of Adhesion Wealth, and we're going to talk about direct indexing and ESG portfolios.
Our mission at Resilient Advisor is to have a significant impact on the retirement crisis by educating and empowering financial advisors to better serve their clients. We bring you industry thought leaders and experts to help you make a difference in the lives of your clients.
Barrett, this is your first time coming on the show. I really appreciate you coming on to talk about direct indexing and ESG portfolios, but let's start with a little bit about your background in Adhesion Wealth. Tell listeners a little bit about your journey through the industry.
Yeah, well, and thanks very much for the invitation, Jay. I really appreciate it and appreciate the invitation to jump on the show. So yeah, my name is Barrett Ayers. I'm the president of Adhesion Wealth. So Adhesion Wealth is a managed account platform. We help independent investment advisors build, manage, construct, oversee, and effectively outsource their portfolio management capabilities. So I've been with Adhesion. I'm one of the founders. I've been with the company for over 16 years now, and been in the industry, bounced around between large enterprises and independent advisors. I was myself an independent advisor, and one of the reasons we got into this business is because we felt an important need that advisors needed to outsource investment management and portfolio construction so they could really focus on working directly with their clients. And so our vision, our ethos is all about how can we help advisors outsource and be better at what they do. And that's really kind of that's how we got here today.
So Barrett, what I have found in my practice, one of the hardest things for advisors to really get their heads around is what the outsourcing of investment looks like. So before we get into the topics of today, when you're working with an independent advisor and they're looking at engaging Adhesion, what does that process look like on coming on board and then outsourcing that investment management process?
Well, it's a great question. It gets asked all the time. In fact, it really depends on where you're coming from, right? So if you're an independent advisor, you're a wealth manager, and you've already got a business, you've got a practice and portfolios in place, that's kind of one end of the spectrum. Captive advisors who are working at a wirehouse or an independent broker-dealer, that's a different path forward. So we start there. We start kind of where you are today and what it is you're trying to accomplish. And really through that discovery process, we find that there's a handful of kind of key characteristics that define what the engagement looks like. The first really is how hands-on or hands-off do you want to be? And that really kind of has a whole decision tree, a whole series of threads that it kicks off during our onboarding process. So we've got some advisors who want to be very hands-on. They want to pick the managers. They want to build their own models. They want to build their own allocation, define the rebalancing bands and the trading characteristics and tax capabilities, and that's fine. There's other advisors who say, look, I came from a wirehouse. I don't want to do any of this stuff. I want to go out and I want to grow my business, and I want to talk to my clients, and I really want to focus on my practice. And that's fine too. So depending on where you are on the spectrum, certainly we have a solution that's available for you. And then obviously anybody in between. So really where we've been getting a lot of traction lately are with firms that are looking to either roll up advisory firms, and maybe they want to go acquire practices, or they want to change some multi-firm affiliation model, and they want to build their own allocations and let all of the advisors that roll up to them consume those investment strategies. And that's more of a TAMP model. And there's obviously the enterprise model, and there's the traditional wealth manager model. And we support all of those depending on where you come from and what degree of engagement or kind of decentralization you would prefer.
So Barrett, I'm not a recruiter, but I work with a lot of breakaway advisors. And the hardest part in the beginning is the educational journey, especially if you're moving from a wirehouse or a broker-dealer model to the independent side. At what part of the process does it make sense to start having conversations with Adhesion or organizations like yours?
Well, we work with a lot of recruiters, right? So we don't personally recruit. We work very closely with the recruiters. We work very closely with the custodians. And typically they bring us in once the advisors decide that it's probably time to break. And it's really, you're right. It's really complicated. It's also really confusing. There's a lot of noise out there about the right path forward. Right. And there's some advisors who really think that the technology idea makes a lot of sense. Go load my firm up with a lot of technology and we'll have all these capabilities. And what we've found is a number of advisors kind of go down that path and have all the technology you can dream of. And then they realize that, geez, this isn't helping me grow my practice any. Maybe I can rebalance the portfolio perfectly, but am I really getting all the value out of growing my practice that I need to get? And so some of them take a step back and say, maybe I don't need all of this technology. Maybe I need to outsource some of it. So typically it's pretty close to the point where an advisor may break away. And then in some cases, like I said, they've already broken away, have some technology and say, maybe I need to divest myself of some of these capabilities and really focus on the business growing aspect of the practice.
Yeah, if you're an advisor and you're watching this as part of your educational journey, trying to determine if a break makes sense to you, I think something Barrett just said is incredibly important. And I encourage every breakaway advisor to think about. All the technology out there looks great. There's never a bad demo. It's shiny. It looks like it's going to do everything for you. And it, at the end of the day, becomes incredibly cumbersome. You really have to build the most simple system you can for yourself so you can execute and not get distracted by the shiny object. Barrett, it sounds like part of your process is helping to flush through some of that to make sure they can focus on their core value proposition.
That's right. And we've had to really focus on that lately. And, as horrible as COVID was and the pandemic was, one of the silver linings, I think, is as advisors started to realize that, maybe fees were starting to compress and maybe they need to spend more time with their clients. Clients were scared, obviously, during the first and second quarter of last year. They need to spend more time with their clients, and fees were dropping a little bit. The markets were dropping a little bit, and they came and they looked at their P&L and they said, "There's some things on my P&L that are not varying with the market decline, and those may be the hard fixed costs of software." So, geez, if I could get rid of some of these hard fixed costs of the software, then maybe I can, again, repurpose some of those investments. And so we do. We help them. They come to us and we say, look, you could get rid of this, this, and this if you outsource your investment to us, and our costs are variable. So we go up and we go down with the market oscillations. And so that's very, very much part of the process as we engage with an advisory team.
Excellent. Well, let's get to the topic today. Barrett and I have had several conversations over the years, and we can talk for hours about the industry, where it's heading, and what advisors should be thinking about. So let's stay on topic and let's talk about direct indexing trends. Tell me, what are you guys seeing at Adhesion Wealth as it relates to advisors leveraging direct indexing in their practice?
Well, first of all, and I'll kind of set the backdrop for folks that are listening. So Adhesion's been in the direct index business for, I think we're going on 11 years now. So we've run an off-the-shelf direct index, an S&P and a couple Russell products for a number of years now, has track records and things like that. It's available only really for Adhesion clients, but we understand the business. And so I'll back up a little bit. Maybe it makes sense to do a bit of a recalibration on exactly what a direct index is. There's a lot of noise out there about it. I've seen Forbes and Barron's and even some retail-facing publications starting to talk about direct indexes. So it's expanding, right? The creep is definitely there. So first of all, a direct index, if you know what an ETF is and you know what an index is, then you really know what a direct index is, right? The way I describe it is you open up a screw off the top of a ETF and you drop out the holdings onto a table. All those holdings are basically a direct index. Imagine taking all those holdings and sticking them into your client's account. That's a direct index. Now, as most of us know, there are many holdings in an index, and some of them may not necessarily contribute to the return profile of the portfolio. So rather than have, let's say, 500 holdings in an S&P 500 in your account, maybe you could get the exact same return risk profile as that index with maybe 100 holdings. And so what Adhesion does is we do what's called index replication direct indexing. So we'll take, let's say, S&P 500 holdings, 500 of them, and distill it down to 100 of them. And of course, like I said, we've been doing that for 11 or 12 years now. So that's really what a direct index is. You take these holdings, you put them into your client account, and then from that, there are a whole series of really important benefits. The first is customization, right? So you can take those 100 holdings, and if your client has some sort of preference around what they want to hold and what they don't want to hold, maybe expressed through, let's say, environmental social governance factors, ESG, we can layer on what we call an ESG overlay on that. So the advisor can call us up and say, I don't want carbon, I don't want these types of businesses. We can apply a screen and we can filter them out, or we can filter them in. So we can say, hey, let's take this ESG universe that you really like, and let's make that our starting point. Let's take that starting point, make it look like the S&P 500, and distill it down to, let's say, 100 holdings. So first of all, it can be very, very customizable. It can be exactly what you or your clients are looking for. The second is because unlike an ETF where you don't hold the underlying holdings, you hold the basket, the single security basket. By holding the individual holdings, it's a very tax efficient vehicle as well. That means that we can go through those 100 holdings and we can look for ways to harvest losses. So it becomes a very tax efficient vehicle as well. Now, Adhesion, as we mentioned earlier, is a managed account platform. One of the things that we do, we specialize in multi-manager, what's called unified managed accounts, or UMAs. What that allows us to do is we can build, let's say, core satellite portfolios with a direct index in the middle and other managers around it, all inside of a single account. So where many advisors had been buying separate accounts in individual accounts, we now have the ability in a single account to hold, let's say, 5 managers. And when you put a direct index into that single account, it does a couple of really important things. First, it allows Adhesion to start to generate losses in that direct index. Those losses can be used to offset gains in the satellite holdings. So now we're talking about creating a tax neutralized portfolio by virtue of having that direct index in there. We've also talked about the way to customize and filter it so that it looks very attractive to a client. It reflects their desires and needs. I can absorb into that direct index legacy low basis holdings. So if your client is breaking away with you from a wirehouse or a broker dealer, and you want to take those holdings with you, we can build a direct index around that so we can absorb in those holdings. Also, if the other managers in those satellite holdings are buying and selling securities, rather than selling them, we can move them over to the direct index core and to absorb them into the core. That now means that there's far less trading and trading friction resulting from that particular those transactions. So, and the last thing that's really important too is we also can prevent things like wash sales, right? So where you may have a direct index in one account and a large cap growth manager in another account, they're all buying and selling Apple, right? So because it's in a single account, that direct index has the ability to discontinue wash sales or prevent them from happening. Now, the other important thing is that because it's a direct index, and it's what we call a passive solution, the cost of it is really low. So if you've got a core satellite portfolio with 50% of this direct index in it and other active managers around the satellites, it can bring that average blended product cost way down. Average direct index on our platform is about 15 basis points. So you could build an entire blended portfolio in the 30 to 35 basis point range and still be a very competitive solution. That reduction in product cost fee helps insulate the advisor from having to reduce their own fees, because we're going to take the product cost and crunch it down to a more palatable place.
A lot to unpack there, Barrett. So I'm going to put on my nerd hat first. So let's say we're trying to replicate the S&P 500 risk return characteristics. You're getting it down to 100 stocks. How do you do that? Is it something that is analyzed quarterly, monthly? What is the process from the advisor standpoint? And then number two, can an advisor deviate from the S&P 500 or the Russell 1000 and get into some of these more esoteric indexes for replication?
Yeah, it's a great question. So we use a process called mean variant optimization. And basically what it does is we use a 64-factor model that does correlation and comparison analytics between the index and the holdings. And we run through that on a weekly or monthly basis, and we can reconstitute the index if needed. So we work directly with the advisor to say, how far can this thing deviate before we bring it back? That's part of the parameters of the definition of the program. So typically, we don't recommend that it be analyzed, let's say, every quarter. A monthly is probably makes the most sense, but sometimes we go as far as quarterly. And so typically, what we're looking for is a tracking error statistic that makes sure that it aligns tightly with the associated benchmark, right? Because remember, we're trying to track a benchmark. We want to make sure that we're tracking it properly. So as for your first question, it's a 64-factor fundamental model that we use inside of a mean variant optimization routine. That's the process to keep it looking like the index. The second question you asked is how far can the advisor start from a different starting point? And kind of what other things can they put on top of it to make it theirs? It's a great question. So recently we launched a program called Personal Indexes, and that allows an advisor to come in and say, I want to start from a different core. I want to start from a different base, let's say, maybe something a little bit more esoteric. I have a very specific need, so we're going to pick a starting point that's a little bit different. And then on top of that, we then say, okay, well, what's the objective here? What are you trying to do with the index? And maybe the advisor is trying to dampen volatility, or maybe make it an income producing version. And so we can put some tilts on it that allow it to kind of to vary and deviate a little bit, but create some sort of objective that the advisor is trying to promote. Volatility these days has been a very popular one. And then we can constrain the output. So we may want to say, geez, I don't want to do it with 100 holdings. I want to do it with 75 holdings, and I want it to be equal weighted. So then we can put some constraints on the output. And finally, we can let the advisor define the universe. So rather than starting with, a Russell 3000, maybe we want to start with a carbon-friendly universe and filter that thing down. So when you're done, you have an ESG-friendly or ESG-specific portfolio that has volatility dampening on it. Also has maybe a more palatable 50 holding version of the model, following an index that that fits inside of your allocation parameters, and is designed really for your specifications. Now you take that model and you stick it inside, again, a multi-manager UMA, and that's really where the supercharging capabilities come into place.
Do you have clients that just use direct indexing and don't mess around with pairing it with SMAs?
We do, sure. Yeah, we have plenty of folks who come to us just for the direct index capabilities. What we found is that it's usually paired with something that is maybe not on the Adhesion platform, right? And so what typically happens is they'll have a direct index with us, and then maybe some mutual funds or ETF somewhere else. So absolutely, we're more than happy to help just fulfill the direct indexing capabilities for any particular client. Happy to.
And are there any custodian constraints as it relates to leveraging your services? Well, I'm sorry, let me ask that differently. What custodians can they leverage the direct indexing services with?
Well, so Adhesion as a managed account platform, we do sit on top of most major RIA type custodians. That include Schwab, TD, Pershing, Fidelity, and Trade PMR. So the nice thing about that is we can build a direct index for an advisor, or multiple direct indexes for an advisor. It can sit up in a cloud basically on the Adhesion platform. We can trade it, rebalance it, execute it, and then all the executions then flow down to the individual custodians. So we're not really constraining the advisor to one given custodian. We can have one version of the model that covers all those custodians.
Wow, that's fantastic. And, we don't want to talk any details about pricing, but you had mentioned 15 basis points earlier. When I think about some of the ETFs that I've been researching for advisors, when they've requested, a little deeper dive, I mean, they're charging, 20, 25, 30 basis points for ETFs that have $1 billion in them. And what I'm hearing from you is for less than the cost of the ETF, they're going to have the individual securities, in theory, using your platform. Is that correct?
That's exactly correct. That's right. And that's the reason why direct indexing is taking off, is because people are starting to realize that you don't have to compromise price, right? It's, they're roughly the same price, some cases, as you pointed out, even cheaper than an individual ETF. So, and the nice thing is because if we can constrain the index, the direct index in such a way, you can really bring those account minimums down too. You don't need to hold all 500 securities. So this is appropriate for an account that's maybe $50,000, $75,000, $100,000 in value. Mm-hmm. So suddenly, the advisors are starting to notice that, again, low cost, tax efficiency, customization, personalization in an account that doesn't need to be a $5 million account size. It's pretty exciting.
Yeah, I'm thinking of like dividend aristocrat portfolios that some of these advisors are building. Do you see a lot of that?
We do, absolutely. In fact, we're working with one of our firms today to work on a dividend aristocrat portfolio as a starting point. That's exactly right.
Yeah, because then you get the extra tax benefit of having that overlay on top of the dividend portfolios, and you could just start with the dividend aristocrat index, I assume.
That's exactly right. You open that up, and that's your starting point, and then you layer your constraints on it, and that's exactly the way it works.
Awesome. Barrett, we're up against our time. It goes so quick every time you and I have a conversation. I always feel like I learned something. For viewers and listeners, to learn more about Adhesion, please visit adhesionwealth.com. That's adhesionwealth.com. You'll also find a tremendous amount of resources, including information that we talked about today as it relates to direct indexing. Barrett, thanks so much for coming on the show.
Jay, thanks for having me. I appreciate it.